Thanks for clicking. Canada's fixed mortgage rates continued their downward trajectory this month, with bond yields continuing to fall as investors continue to predict that the Bank of Canada will be pausing on its path of rate hikes following Wednesday's announcement. Whether or not the Bank of Canada will pause on its path of rate hikes remains to be seen, and despite continual rate hikes that we've seen over the past few months, some are starting to wonder whether or not it's best to go with a short-term mortgage. A shorter-term, fixed-rate mortgage that allows borrowers to lock in their mortgage payments for a couple of years without taking on the risks of a variable rate mortgage.
Risk? What risk?
Indeed, given the number of Canadians that took out variable rate mortgages during 2020 and 2021 and are now regretting it, there's a real sense out there that buyers don't want to miss out on the savings when the Bank of Canada does eventually lower rates, if and when they do, but also don't want to risk a mortgage payment that could continue to go higher if the bank does continue to raise rates in the next year or so. So what I want to do today is go over my best 5-year fixed rates and compare them to where they were last month. Then I want to take a look at the advantages and disadvantages inherent in shorter term mortgages, as well as current short-term rates, and then we'll discuss what to look for next. We'll get a much better idea of the Bank of Canada's thinking on its path of rate hikes at Wednesday's announcement, and we'll obviously have an update out on that announcement on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these rates. First off, the best insured mortgage rate. An insured mortgage rate, if you'll remember, is where you put less than 20% down. You qualify based off a 25-year amortization and an interest rate of 5.25 or 2 points above the contract rate, and you pay the mortgage insurance. The best 5-year fixed insured mortgage rate in November was 5.29. That dropped down to 4.99 in December, and as of right now is 4.79. And a 5-year variable rate mortgage, similar to last month, is prime minus 1.05 or 5.4 for now. Next up, the best 5-year fixed insurable rate. An insurable mortgage rate, if you'll remember, that is where you have 20% down, you have a 25-year amortization, and you qualify at 5.25% or 2 points above the contract rate, the rate you actually pay, and you don't pay the mortgage insurance. The best 5-year fixed insurable rate in November was 5.39. That moved down to 5.14 in December, and that has actually stayed the same and is still 5.14 in January. And my best insurable variable rate mortgage as of right now is prime minus 0.5 or 5.95%. Finally, uninsurable rates, which actually did drop this month. Uninsurable rates is where you have 20% down, you have a 30-year amortization, or you take money out of your home vis-a-vis a refinance or an equity takeout, and you qualify based off 5.25 or 2% above the contract rate, and of course you don't pay the mortgage insurance. The best 5-year fixed uninsurable rate in November was 5.44. That dropped down to 5.24 in December, and as of right now is sitting at 5.14, with a 5-year variable rate mortgage sitting at prime minus 0.5 or 5.95. So insured mortgage rates down about 0.2%, insurable mortgage rates have stayed largely the same, and uninsurable mortgage rates are down about 0.1%. But as we said at the beginning, some are questioning whether or not a 5-year fixed mortgage rate is the way to go, with many people wanting the stability of a fixed mortgage rate, but still wanting to be able to take advantage of the Bank of Canada's reversal of the bank lowering rates when and if that does come.
Probably tomorrow.
Shorter term rates, for their part, are not that great right now, with a 1-year fix sitting at 6.04, 2-year at 5.74, 3-year at 5.34, 4-year at 5.24. And as we said, the 5-year fixed insured rate sitting at 4.79. However, the argument being put forward is that rather than taking on a 5-year fixed insured mortgage rate at 4.79, buyers can take out a 1 to 3-year term, and then hopefully by then the Bank of Canada will have lowered rates.
I got my car back.
And buyers can re-lock in at a lower rate. And at first look, the rationale makes sense. A widely cited and widely misunderstood study by Moshe Milevsky found that variable rate mortgages historically perform better than fixed rate mortgages 4 out of 5 times. And the study also found that 1-year shorter term mortgages also have an edge over the 5-year fixed. And Milevsky says that the same remains true for today. with the Globe and Mail noting that barring a major increase in inflation, variable and short-term fixed-rate mortgages will eventually fall below that of 5-year rates. So the argument being made is that when buyers choose a 1, 2, 3-year fixed-rate mortgages, they are betting that by the time of renewal, they will be able to take advantage of the Bank of Canada reversing course and being able to renew at a lower rate. However, much as he did during the article that is so widely cited, and I suspect rarely read, Milewski continues to warn buyers against making those bets, citing a number of other factors that need to be considered. For instance, there is a fairly good chance that a home purchased today won't be worth the same amount of money in a year from now. So if a homeowner goes to renew their mortgage in a year and that home is now underwater or that home isn't worth the purchase price, they could have a real hard time switching to a different lender.
Think about it. I mean, he's in a joint 24 hours.
Yeah, this would very much put the borrower at the mercy of their current lender. The lender can offer basically whatever rate they want, and there's very little that the homeowner could do about it. Not to mention, it's not out of the realm of possibility that rates could be higher in a year from now, in 2 years from now. I think it's very easy to forget that at this point in time last year, all of the big banks were predicting a policy rate between 1 and 1.5% by this point in time this year. And the policy rate is currently 4.25. So, yes, inflation is coming down so far. Headline inflation is coming down, mostly to do with gas prices. And core inflation is coming down, although minutely. That doesn't mean that it's not going to remain sticky. That doesn't mean that we're going to be out of the woods in a year from now, despite all of these predictions. As we saw, all the predictions from last year at this point in time turned out to be massively overly optimistic and overly wrong. So while shorter term mortgages will most likely and have historically benefited those who choose them over 5-year fixed rate mortgages, Milewski, the author of the study, is warning buyers to look at their own personal balance sheets, their own budgets. Milewski notes himself in the interview that although he himself has a floating rate mortgage, he has an adjustable rate that changes with prime. He can withstand the risks that the home has declined in value, the risk that rates could be higher in a year. Milewski can withstand those risks, but as he notes, many people can't. So, as always, as with variable rate mortgages, as with fixed rate, whether it be 1, 2, 5-year fixed, it really comes down to your personal budget. There's no guarantee that rates will be lower in a year, in 2 years from now. There's no guarantee that the home will still be worth as much as you paid for it right now. So in summary, fixed rate mortgages are on a downward trajectory, with many buyers considering shorter term mortgages, shorter term fixed rate mortgages, as they await a reversal coming from the Bank of Canada in the next couple of years. Historically, that is a strategy that has worked, but with anything, it's important to consider your own personal budget when going forward, when choosing shorter terms, as rates could always go up. They'll probably go down, but as the predictions from last year have shown, nobody really knows anything. You only know your budget. We will have a better idea of the Bank of Canada's thinking at the rate announcement on Wednesday. We'll obviously have an update out on that thinking on this channel. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.